Welcome to Web3 Watchdogs, the podcast that takes a deep dive into the world of Web3 security, compliance, and risk. Join Michael Pearl as he interviews executives from across the Web3 industry to uncover the challenges and opportunities of this rapidly evolving space. Web3 Watchdogs is sponsored by Cyvers, your one-stop shop for Web3 security and threat mitigation. Cyvers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cyvers.ai. That's CYVERS.ai.
Well, hello everyone, and welcome to the Web3 Watchdogs, the podcast that focuses on everything security, risk, compliance, fraud prevention, basically everything that has to do with safety and security in the Web3 space. And today we have with us Martins Benkitis. Martins is the co-founder and the CEO of Gravity. Martins, welcome.
Hey, Michael, great to be here.
Likewise, very happy to have you here. So, Martins, you have a very strong background. You've been involved in international business. You are also kind of on the line. We just talked before the call between Asia and Europe. Please tell us about yourself, about your background, and how did you come to eventually found the Gravity team?
Yeah, so I'm originally from Latvia, but I did finish my studies in Netherlands, in Rotterdam School of Management in Rotterdam, and after which I actually went to a study exchange in Thailand, in Bangkok, and kind of decided to actually stay there after it. Yeah, and that's where the kind of the bridging between East and West took place, and around 2017, when we had one of the early first two bull markets ago, this were going crazy across the world, and I noticed these so-called kimchi premiums or tom yum premiums that existed in various markets in Southeast Asia, and my mother was actually coming for a holiday to visit Thailand, and I was able to get her a 20% better exchange rate by buying Bitcoin with fiat in Europe, sending it to Thailand, and then cashing out. And that event really kind of broke my mind about the extreme inefficiencies that exist at that time. And so I really thought that I should be able to fix it in a way, because the inefficiencies are so huge that I thought that even a newbie at that time like me would be capable of solving those. So me and my co-founder Edgars, who I know since who's my good friend since back early school days. We tried to understand the inefficiency, why it exists, and that was basically the birth of Gravity team. How it all started. We focused at the start on the Thailand market and tried to understand how to provide liquidity in these very fragmented, so to say, awkward local markets, and we really understood how to do it well and nailed the math and nailed the operations, and then we just scaled out from there on. And today we trade in 40 plus different venues and trade approximately 1% of all volume. That's how our whole story started, with these kind of very humble beginnings, kind of in the basement, writing up some code to trade in these local markets.
Very interesting. And, fast forward to today, tell us a little bit more about Gravity. What kind of venues are you trading on? What kind of assets are you trading with? Where's the source of the funds? Basically, who are your investors? Give us kind of behind the scenes.
Yeah, so we still do have a heavy emerging market focus. So we try to follow people when we are choosing the locations where we want to go. So we go for markets that have basically for countries that have a high population, that have like large retail base, and we really try to follow the people rather than the volume, because in crypto actually you do have a lot of instances of fake volume, which we already noticed 2017, but even still today they exist. So we do have a very strong emerging market focus. And also we trade in exchanges across the globe, across all continents, pretty much except for Antarctica, I would say. And we trade more than 400 different currencies, cryptocurrencies. So we also dive deep into the long tail, and we really try to basically support as much volatile assets as the market demands.
Yeah, and can you give us kind of an overview? I'm guessing that if you want to trade on multiple venues in hundreds of different currencies, obviously the technology has to be up to speed in terms of facilitating all that, in terms of low latency. How does it work? How did you manage to set this up? Who is the team behind the technology?
Yeah, so most of our technology stack, we have built everything ourselves in house. I think when we started out in 2017, 2018, latency was not really an issue because well, the rest of the players were not as sophisticated as they are today. So we were kind of measuring our latency in like sometimes even seconds. At the start, we were measuring it in seconds. Today, it has gone way down to microsecond level. But yeah, of course, we do need to have a very low latency systems. Well, the latency game is basically spinning around a lot around AWS because that's where most of the crypto exchanges are hosted. And you basically need to know very well how to operate in that environment because what is different from traditional markets compared to crypto is that in crypto, liquidity is actually distributed across various AWS centers. Like you have Binance is in Tokyo, Bybit is in Singapore, you have Coinbase in Virginia, AWS, and those are all venues where price discovery happens. And so you need to make sure that you optimize your round trips between these venues because that really then plays more of an importance than say than when you're say using traditional finance approach where you have ASICs and you have placed your machines right next to the servers as close as possible. In this case, it's a bit different because liquidity is dispersed across multiple venues. So that's one of our core focus when it comes to latency game. And of course, yeah, then just having a very robust infrastructure to be able to provide consistent liquidity across many exchanges, and also make sure that you have enough inventory everywhere at all times, and that you have basically ability to rebalance the assets, make sure that yeah you're always able to quote the books is another kind of like logistical problem that is also logistical math problem that is very exciting to solve. And yeah, we've been doing all of that in house since the start because it's of course very crucial to our competitive edge. And so we don't that part we really try to do internally.
Yeah, and I read that you guys claim to have facilitated over $400 billion since 2017. Is that correct?
Yeah, I guess right now that number probably a bit over 500, possibly. Yeah, it keeps on increasing over time.
Very interesting. And maybe before we dive in deeper and talk about the security aspect of it and the risk management, maybe just to set the table, because I'm guessing not all of our listeners really understand the difference between a market maker, liquidity provider, hedge fund, trading consortium, a crypto fund. Maybe you can give us kind of the 101 on how it works and where gravity is kind of placed in that metrics.
Yeah, it's true. I think actually these terms sometimes are not super well defined for the players themselves. But the way I see it is, well, market makers are often thought as those that provide liquidity to tokenized projects specifically that are basically supporting token launches. Yeah, we do that as well. We do token launch support and provide liquidity to tokenized projects. That is a business line we started few years after starting our kind of initial business. Our initial business would probably be called more of the hedge fund proprietary trading firm distinction, and that's basically That basically means that we trade at the core with our own funds. We trade for our own kind of profit optimization, and that's kind of how we started. We didn't really have clients. We were just using our own funds to trade for profit. Now over time, as you kind of get get better in the craft that you're doing, you realize that with your trading activity, you're actually creating added value to other market participants as well, which are exchanges and tokenized projects. Exchanges benefit from the liquidity that you bring on the table, and so do tokenized projects as well. And at some point, you actually engage into sort of like relationships with these parties, and I guess at that point you are migrating from a prop trading firm, a hedge fund definition, into a market maker slash liquidity provider.
Yeah, that's super helpful. And just to complete the picture with respect to Gravity, are you mostly focused on centralized exchanges or DEXs as well?
Yeah, Dex is definitely on our roadmap, and we are exploring ways how we can do more there. But yeah, at the core today, we are the biggest on centralized venues.
Got it. And moving on to the security issue, I'm really curious to hear because I know that again, just I guess our listeners already know that Cyvers basically is detecting all the major crypto hacks, even the smaller ones, but we just don't publish them. And one thing that I see time and time again, and unfortunately myself, I have to be the one that is bearing the news and calling the CEOs, telling them that they were hacked even before their systems detected it. And what we oftentimes hear from other clients of ours is that basically their funds and their positions are in danger once something like that happens. And we saw that obviously with the Bybit hack and most recently with the CoinDCX hack. Just curious about how it looks like from your side. What are the dangers? What are the perils when you are investing in centralized exchanges? What can happen when this centralized exchange is hacked? Is your money gone? Is your position gone? What is your protocol with dealing with that?
Yeah, of course. For us, this counterparty risk that we face is one of the major risks we have in the company, because essentially we need to, as a market maker, a liquidity provider, we are kind of like the lifeblood of all crypto trading, because we always have to stand on the other side of the trade for those who want to engage and build up their positions. We are naturally always exposed, and the exchanges, we need to do like very careful due diligence when evaluating the exchanges to understand what risks we are actually seeing with them, and whether they actually fit. Or there have been all sorts of events that we have gone through, starting from FTX hack back in the days, or FTX, yeah, not the hack, but the whole fraud case of FTX. Also coming back to, yeah, like more recent situations with Bybit and Indodex, or other exchanges that get hacked. And yeah, basically, I think it's great that there are certain kind of preventive measures to be able to react to these situations early on, and actually react before the withdrawals get.
Yeah, and full disclosure, Cyvers is working with Gravity. We recently published our partnership, and that's one of the things that we're helping Gravity with. And happy to hear that it lowers your counterparty risk and basically keeps your funds more safe.
Yeah, absolutely. Yeah, absolutely. It's knowing that fact that there is a way to kind of react to things before things actually, hit the fan, so to say, is a great encouragement. And again, yeah, I remember from our experience working with you guys. So yeah, we went through this situation with Bybit, where actually I remember you guys notified our team before the event took place, and that helped us. That actually helped us to trigger our responses in timely manner. And same also with other situations that we've had in like smaller regional exchanges. We were able to take the preemptive measures in a very timely manner. So yeah, it's a great tool, and it's a very interesting innovation that you guys have brought forward, because in traditional finance, I'm not sure if such kind of tools would be possible to enable because of the lack of transparency. And in a way, the transparency that exists in crypto actually sort of enables heightened security, because you're able to see things when they happen, and you don't have to rely on credibility of some third parties to deliver that information to you or not.
Yeah, totally agree. And just picking your brains as a market maker, right? So one of the things that we see, and there are some researchers that are actually backing the data, projects that have tokens and that are hacked, primarily DeFi projects, right? We see their token drop significantly, and for the most of it never to come back, or maybe come back in 6 months if they're lucky. Is it something that you see as well with respect to projects? And we can name so many projects, unfortunately, that were hacked during the last year and last 2 years, and their token really suffers. Is that something that you also see from your perspective?
With regard to tokens,
Yeah.
yeah, of course, like these hacks are not great. I mean, we had experienced some as well, and we have been affected with some. I think we got affected with the Gala token hack, which exists. I think it took place like some 2 or 3 years ago when they
Yeah.
were hacked, and their BSC chain was hacked. And of course, it's like a bad hit for the whole reputation, and definitely not something that I would ever wish to any project to go through. But yeah, unfortunately, these things keep on happening. But I do feel also that they're slowly, the industry is slowly maturing, and there's less of these events happening as compared to, say, 2021 and up. You do have better practices in place. You do have better practices also within companies in place to avoid these events, but they will surely keep on existing, because the reward for these hacks is just so enormously high, and therefore there will always be some bad actors trying to exploit them.
Yeah, I tend to agree with you that the industry is maturing, and we see that with our clients as well, and with other players in the industry. The problem here is that the hackers are maturing as well, right? So you see, especially Lazarus Group and other kind of criminal networks that are very, very sophisticated, that have oftentimes state funding. And at the end of the day, when you improve your protection, so do they improve their offensive measures, and you always have to stay updated with the current threats. So I totally agree that there is more awareness right now, but it only means that you have to keep learning and keep implementing new tools and new kind of operational procedures to basically prevent the hacks. So I wanted to ask you, so it's quite clear, especially for our listeners, and we had quite a few exchanges, leaders of exchanges coming up on the show, and some DeFi protocols as well. The regulation there is to some extent clear. When it comes to market makers, how does it look like from the regulatory standpoint? What kind of regulatory framework do you have to adhere to, especially given the fact that you're global and that you trade on global markets and that your investors and token issuers are global as well? How does the regulation considerations look here?
Yeah, I think with the market maker regulations and how market makers are governed and regulated really comes down to the distinction whether liquidity providers, market makers are holding their clients' assets on their behalf. When this actually happens, then usually there's the virtual assets service provider responsibilities turn on, basically. So if you are custodying your client's assets, then you usually need to have a license, and you need to be licensed in some sort of jurisdiction and abide with all the KYC, AML, anti-money laundering rules, and implement the travel rules, and so on. And I think that's the general distinction. And with us, with Gravity team, currently we are in the phase of becoming that custodian, but we are not there yet, because we do not have a kind of customer front end per se yet. So we're not really trading on behalf of clients. We're trading on behalf of ourselves still. So yeah, I think that's where the distinction goes. But if we look on a general kind of perspective, of course, the industry is going in the way where it is understanding the importance of these actors, and the regulations are also coming in place to regulate the players. Also, yeah, the recent regulation package, called the Clarity Act that was released in United States just a few
Yeah.
days ago, is also basically talking about the role of crypto brokers and the requirements that they need to basically fulfill to qualify for a local license. So yeah, I think in general, what's happening right now is just this massive kind of wave of coming in, and that the companies need to decide whether they go fully DeFi and don't play the institutional game at all, or they need to adopt, yeah, get licenses where their products require that.
Got it. And so you mentioned the Clarity Act, and obviously concurrently with that, with the Genius Act, right? And
Yeah.
now everyone's talking about stablecoins. Not only now, I mean, it is already a trend that is, let's say, has been going on for over a year. And as we all know, stablecoin volume has already surpassed the ones of MasterCard and Visa. And stablecoins are the new kind of trend of this crypto summer, of this rising wave. So with respect to stablecoins, I'm curious. At the end of the day, market makers, they profit from those fluctuations, the volatility, the premiums, as you mentioned in some cases. What happens with stablecoins? I mean, how do you manage the liquidity? What's the incentive here with respect to stablecoins? Because presumably it's all pegged to the dollar, right? So how do you profit from that, and what's your incentive to basically move the liquidity from place to place?
Yeah, absolutely. Yeah, that's an interesting question. So the incentives are still there. There's multiple of them. Well, first of all, you can work with stablecoin issuers themselves, because they do want to work together with market makers, liquidity providers, to use their help to make sure that there's plenty of liquidity of their token across various venues. So there's a way how to work with tokenized issuers. There are also, of course, there can possibly be arbitrage opportunities between different markets, and there are spreads, the bid ask spreads, even on stable coins, which are generally stable assets. They still, when they get traded on secondary markets, their price is not always one-to-one representation of the dollar value or anything of that sort. And I think also what is quite an interesting and compelling feature of stablecoins is that they can be used as the kind of rails of global value movement. And I think that's obviously the very one of the main premises of why stablecoins are raising right now, is that they can actually be used to replace our traditional payment systems like Swift, SEPA, ACH, and so on, which are, in my opinion, quite outdated. Now, in order to move into dollar, say, from you, but at the same time, you still need to move from fiat money into stablecoins. So you need to have liquidity providers that are actually quoting stablecoins to fiat currencies, and that's where you also have opportunities for market makers, liquidity providers, to engage and try to take into account all the market trends, all the forex, the premiums, and so on, to price these assets properly. And it's quite an interesting new field that is developing very actively right now. And I think there's a lot of demand for such kind of services in the future, because the traditional necessarily know how to deal with the intricacies of stable coins, and they maybe know how to trade the forex currencies, but when it comes to stable coins, it adds a bit of an extra layer of complexity that they need to deal with. you do need to have kind of crypto native liquidity providers to navigate that realm.
Yeah, I totally agree with that. I just wrote a post on LinkedIn on how, and that's something that I'm hearing from quite a few payments companies that we're in touch with. Basically, all the payments companies are already racing towards adopting stablecoins. And obviously, we have the usual suspects, right? We have Stripe and PayPal. We already know that they're implementing stablecoins, and PayPal has its own stablecoin. But I think that even the smaller players that were kind of very reluctant to adopt stablecoins and crypto in general, they are going to be all in right now on stablecoins because they will have no choice. And my guess that it will be kind of in the background, right? So the stablecoins, the market makers will be very active in that, but from the user standpoint, this will all be in the background. They will see fiat from one side and fiat from the other side.
Yeah. Yeah, it's true. Yeah, to your point, I think it's interesting these days. You kind of see that there's this kind of fear of missing out almost taking place. Whereas a few years ago, if you would mention crypto to a lot of these companies or banks that are now jumping in, they would just stop talking to you, stop your application for account with them because they see the risk levels being too high. But now all of them are. I think that they're also feeling the pressure from their shareholders that they need to be thinking about something, that they need to be adjusting their strategy because suddenly stable coins is kind of potentially an existential threat for their business. Yeah, there's this kind of FOMO movement, and everyone is trying to adjust to the um, existing patterns that are emerging, and quite interesting to see that. Um, so yeah, and I do feel that over time, uh, I do feel that over time the kind of market cap of stable coins is likely to only increase and raise. Today we are sitting around $250 billion market cap, I believe, for stablecoins, something like that. I do feel that towards the end of this decade, it can be in maybe $2-3 trillion, and yeah, the stablecoins
Wow.
can essentially really take over the whole money supply because it's on a kind of like fundamental basis. It's just a better way of how to move value around, and the regulatory barriers were there ever since, and now that these barriers are kind of taken away, you do have much less barriers remaining, which is, I would say, the infrastructure that needs to build out, needs the TradFi players and yeah, these crypto companies, and I think and the liquidity, of course, you really need to make sure that you have plenty of liquidity to facilitate global money movement, and I think those problems are already being solved. And it's just a question of
Mhm.
time because the main roadblock was always the legal uncertainty.
Yeah, I think that still one kind of regulatory hurdle that they will have to figure out how to mitigate is basically the compliance problem, right? Because you're going to be moving so much funds at a very high speed, and eventually, these companies, especially the payments companies that are not used to crypto, they have a very high standard for processing funds and for identifying origins of funds and doing all types of transaction monitoring and things of that sort. This will be a huge challenge right now for them to vet, huge amounts of wallets, huge amounts of funds that originate from many different places, tons of retail money that you have to vet and identify the sources of. So I think that this is going to be the next challenge for them. Now that the kind of the biggest regulatory challenge is solved, and as you said, the liquidity challenge is about to be solved as well. This will be the next challenge, but that's my opinion.
Yeah, you're right. I absolutely agree with you that it is another exciting challenge, and that maybe you guys are actually solving for. But again, because of the transparency that blockchain introduces, you have great tools, and you actually have the chance and potential to build blockchain forensics tools that increase the transparency and actually allow you to see the origin of the funds where they have been sent in blockchain. And yeah, so I think is definitely a very relevant problem that you're as the industry is kind of gearing up and really going into the next level.
So, Martins, thank you so much. I think it was fascinating. I think that you guys at Gravity are doing some tremendous things. Very interesting to hear about the behind the scenes of market making, liquidity providing, and so on. It's kind of very illuminating because that's something that we haven't focused on this show yet. So, very happy to meet you and to talk to you about all those topics. Continue the good work at Gravity. And by the way, where can we read more about Gravity and about yourself? Are you active on social media? Are you publishing anything?
Yeah, sure. You can read more about us on our website, gravityteam.co, and also visit our page on LinkedIn. Yeah, by the same name, Gravity Team. And yeah, I'm also more active on LinkedIn as well, so you can reach out to me there.
And I'll add the links to the show notes. Martins, thank you so much. Thank you.
Yeah, thank you very much, Michael. Thanks for inviting. Bye-bye.
Web3 Watchdogs is sponsored by Cyvers, your one-stop shop for Web3 security and threat mitigation. Cyvers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cyvers.ai. That's CYVERS.ai.